How Netflix destroyed a $6 billion empire. Picture this. It's the year 2000, and entertainment retail is ruled by an absolute king. Blockbuster Video commands a $6 billion empire with over 9,000 stores worldwide and 84,000 employees. Every Friday night, millions of families make their pilgrimage to the big blue and yellow stores, wandering the aisles of new releases and classics, clutching their membership cards like golden tickets. The company processes 4 million rental transactions every single day, generating revenues that dwarf most Fortune 500 companies. But in a small office in California, two men named Reed Hastings and Mark Randolph are about to launch what will become the most devastating industry kill shot in business history. Their weapon? A little red envelope and a wild idea about mailing DVDs. What happens next is a masterclass in how arrogance, complacency, and a failure to recognize disruption can topple even the mightiest empire. This is the story of how Netflix didn't just compete with Blockbuster. They completely annihilated an entire industry and rebuilt it in their own image. The seeds of Blockbuster's destruction were planted long before Netflix even existed, rooted in a business model that seemed unshakable but was actually built on customer frustration. Blockbuster's entire profit engine ran on late fees, which generated over $600 million annually. That's roughly 16% of their total revenue coming from angry customers who returned movies past the due date. The average late fee was $4 per movie, and customers paid these penalties 2.4 billion times between 1998 and 2003 alone. Wayne Huizenga, Blockbuster's founder, had built the company by acquiring smaller video chains throughout the 1980s and 1990s, creating a rental monopoly that controlled both supply and pricing. By 2000, Blockbuster held a 40% market share of the entire home video rental industry, with their closest competitor, Hollywood Video, trailing at just 13%. The company's real estate footprint was staggering. They paid over $800 million annually in rent and lease agreements, creating massive fixed costs, but also powerful barriers to entry for potential competitors. Each Blockbuster store required approximately 6,000 square feet of retail space in prime locations, stocked with roughly 8,000 to 10,000 individual movie copies across 2,500 different titles. The economics seemed bulletproof. Customers had limited alternatives. Switching costs were high due to membership requirements, and the company's scale allowed them to negotiate favorable terms with movie studios. When Reed Hastings founded Netflix in 1997, the idea seemed almost laughably simple compared to Blockbuster's sophisticated retail operation. Hastings, a software engineer turned entrepreneur who had previously sold his company Pure Software for $700 million, was reportedly inspired to start Netflix after being charged $40 in late fees for a copy of Apollo 13. The initial Netflix model was straightforward. Customers could order DVDs online and receive them by mail in distinctive red envelopes, keep them as long as they wanted, then mail them back in prepaid return envelopes. But the early days were brutal. Netflix launched with just 30 employees and 925 movie titles, compared to Blockbuster's massive infrastructure. The company's first-year revenue was a mere $1.4 million, and they were bleeding cash trying to build their DVD inventory and mail distribution network. The technology requirements were immense. Netflix had to develop sophisticated recommendation algorithms, inventory management systems, and logistics networks to track millions of DVDs moving through the postal system. Their first distribution center in San Jose could process just 200 orders per day, and customer complaints poured in about cracked discs, long wait times, and limited selection. Many industry analysts dismissed Netflix as a niche player serving tech-savvy customers who didn't mind waiting days for movies that Blockbuster customers could get instantly. The infamous meeting that would go down in business history occurred in 2000, when Netflix was struggling to survive the dot-com crash and desperately seeking partnerships or acquisition opportunities. Reed Hastings and Netflix co-founder Mark Randolph traveled to Blockbuster's headquarters in Dallas to meet with CEO John Antioco and his executive team. Netflix proposed that Blockbuster acquire their small startup for $50 million, a fraction of what Blockbuster spent on marketing in a single quarter. The Netflix executives outlined their vision. Blockbuster could handle new releases and immediate gratification through their retail stores, while Netflix would manage the long tail of older movies and serve customers who didn't mind waiting for delivery. According to multiple accounts from attendees, the Blockbuster executives literally laughed during the presentation, with some reportedly struggling to suppress their amusement at the proposal. John Antioco later admitted that Blockbuster's leadership viewed Netflix as a very small niche business that might appeal to a few thousand customers, but could never scale to challenge their retail empire. The meeting ended with a polite rejection, and Blockbuster executives apparently joked afterward about the crazy idea of mailing movies to customers. This decision would ultimately cost Blockbuster's shareholders billions of dollars and destroy one of retail's most successful franchises. Netflix's transformation from a struggling startup to an industry disruptor accelerated in 1999 when they introduced their revolutionary subscription model, fundamentally changing the economics of movie rentals. Instead of charging per movie like Blockbuster, Netflix offered unlimited rentals for a flat monthly fee of $15.95, with no due dates and no late fees. This pricing innovation directly attacked Blockbuster's most profitable revenue stream while eliminating the primary source of customer frustration in the rental industry. The subscription model created predictable recurring revenue for Netflix while giving customers unprecedented value. Heavy users could rent 20 or 30 movies per month for less than the cost of buying a single new release. Netflix also invested heavily in data analytics and personalization, tracking every customer interaction to build sophisticated recommendation engines that helped users discover movies they never would have found browsing Blockbuster's limited shelf space. By 2003, Netflix had 1.5 million subscribers and was processing over 1 million DVD shipments daily through a network of 18 distribution centers strategically located to reach 80% of customers with next-day delivery. The company's customer acquisition costs were dropping while lifetime customer value was increasing, creating a virtuous cycle that traditional retailers couldn't match. Netflix subscribers averaged 7 rentals per month compared to just 2.5 rentals for typical Blockbuster customers, demonstrating the power of removing friction and late fees from the rental experience. Blockbuster's response to the Netflix threat was too little, too late, and hampered by the innovator's dilemma that destroys so many successful companies. In 2004, 4 years after dismissing Netflix's acquisition offer, Blockbuster finally launched their own online service called Blockbuster Online, essentially copying Netflix's mail-order model. The service gained 1 million subscribers in its first year, proving customer demand for alternatives to traditional rental stores. But Blockbuster's execution was plagued by internal conflicts and competing priorities. The company's existing retail infrastructure became a liability rather than an asset. Store managers complained that online rentals cannibalized their sales, landlords demanded long-term lease commitments for expensive retail space, and the company's supply chain was optimized for truck deliveries to stores rather than individual customer shipments. Blockbuster's late fees still generated over $600 million annually, creating enormous internal resistance to abandoning this revenue stream, even as it drove customers to Netflix. CEO John Antioco did attempt more aggressive changes, including eliminating late fees in 2005, but this decision cost Blockbuster $400 million in lost revenue and triggered a boardroom coup led by activist investor Carl Icahn. The company burned through $1.2 billion in cash between 2004 and 2007, trying to compete with Netflix while simultaneously supporting their massive retail footprint, ultimately satisfying neither traditional customers nor digital adopters. The streaming revolution delivered the final killing blow to Blockbuster's business model, and Netflix was perfectly positioned to lead this technological transition while their competitor was trapped in physical retail. Netflix launched their streaming service in 2007 as a free addition to DVD subscriptions, initially offering 1,000 hours of content that subscribers could watch instantly on their computers. While the early streaming library was limited and video quality was poor by today's standards, Netflix understood that internet infrastructure would improve rapidly and streaming would eventually replace physical media entirely. The company invested billions of dollars in streaming technology, content licensing, and global content delivery networks, while Blockbuster continued pouring money into retail lease agreements and inventory management. By 2010, Netflix had 20 million subscribers and was streaming over 2 billion hours of content quarterly, fundamentally changing how consumers discovered and consumed entertainment. Blockbuster attempted to launch their own streaming service and video-on-demand partnerships, but these efforts were underfunded and poorly integrated with their existing business. The company's debt load had grown to over $900 million, largely due to their failed attempts to compete in both physical and digital markets simultaneously. Netflix's streaming service created network effects that Blockbuster couldn't replicate. The more subscribers Netflix gained, the more they could invest in exclusive content and better technology, making their service increasingly attractive compared to alternatives. The speed of Blockbuster's collapse was breathtaking for a company that had seemed so invincible just a decade earlier. In 2008, Blockbuster's revenue peaked at $5.9 billion, but the company was losing customers rapidly as Netflix gained momentum and new competitors like Redbox offered dollar rentals at grocery stores and gas stations. Blockbuster closed 1,500 stores between 2007 and 2009, laying off thousands of employees and taking massive write-downs on their real estate investments. The company's stock price, which had reached $30 per share in 2002, fell to under 50 cents by 2010, as investors realized that Blockbuster's business model was fundamentally obsolete. On September 23, 2010, Blockbuster filed for bankruptcy protection, listing $1.465 billion in debt against assets worth just $1.016 billion. The bankruptcy filing came exactly 10 years after they had laughed Netflix out of their Dallas boardroom, and Netflix was now worth over $13 billion, compared to Blockbuster's $50 million acquisition price from 2000. During the bankruptcy proceedings, Dish Network acquired Blockbuster's remaining assets for just $320 million, less than what Netflix spent on content in a single quarter. The last corporate-owned Blockbuster store closed in 2013, though a few franchise locations remained open, serving as nostalgic reminders of a bygone era. The Netflix versus Blockbuster battle represents one of the most complete industry transformations in business history, with lessons that extend far beyond entertainment retail. Netflix didn't just replace Blockbuster, they completely redefined how content is created, distributed, and consumed globally. By 2020, Netflix had grown to 200 million subscribers worldwide, generating over $25 billion in annual revenue while producing acclaimed original series and films that compete directly with traditional Hollywood studios. The company's market capitalization peaked at over $300 billion, making it worth 50 times more than Blockbuster's entire value at its height. Netflix's success enabled an entire ecosystem of streaming competitors, including Disney+, HBO Max, Apple TV, and Amazon Prime Video, creating a market worth hundreds of billions of dollars that didn't exist when Blockbuster dominated home entertainment. The ripple effects destroyed other traditional businesses, including DVD manufacturing, video rental chains, and physical media retailers, while creating new industries around streaming technology, content analytics, and global content production. Perhaps most importantly, Netflix proved that customer-centric innovation could overcome seemingly insurmountable competitive advantages like retail scale, supplier relationships, and brand recognition. Reed Hastings often says that Netflix's greatest fear is becoming the next Blockbuster, complacent, arrogant, and blind to the next wave of disruption that could make streaming as obsolete as video stores. The Blockbuster empire's destruction wasn't inevitable, but it was predictable for any company that prioritizes short-term profits over long-term customer value. Blockbuster had every advantage imaginable: massive scale, deep supplier relationships, valuable real estate, strong brand recognition, and billions of dollars in annual cash flow. They could have acquired Netflix for the equivalent of pocket change, or they could have developed their own innovative services without the constraints of a struggling startup. Instead, they chose to protect an outdated business model built on customer frustration, missed multiple opportunities to adapt to changing technology, and ultimately paid the ultimate corporate price. The $50 million rejection in 2000 became the most expensive no in business history, costing shareholders, employees, and franchisees billions of dollars while handing Netflix a clear path to industry domination. Today, Netflix continues to face new competitive threats from tech giants and media conglomerates, but they've learned the primary lesson from Blockbuster's demise. In rapidly evolving industries, paranoia and continuous innovation aren't optional, they're essential for survival. The blue and yellow Blockbuster signs have disappeared from strip malls across America, replaced by Amazon lockers and food delivery services. But the lessons from this epic business battle continue to shape how companies approach disruption, customer experience, and strategic decision-making in the digital age.